Hey everybody, Marty Mazur. Good afternoon, April 28, 2016. I wasn't going to come to you today, but the market was down a bunch. Dow was down 200 points, as you may have noticed. S&P was down about 20, and the NASDAQ was down almost 60 points. So it was a pretty noticeable down day today relative to what we've been used to of late. So I thought maybe I would just pop in and give you my thoughts and try to keep it quick. So Japan overnight, disappointed in terms of the Bank of Japan and what the market had kind of discounted, and it would have been actions that would have depressed the yen and probably bolstered the Japanese stock market. And traders were definitely on the wrong side of the currency trade. When they didn't do anything, the yen bolted higher about 2%. The dollar came down. Japanese market tanked last night. Not all of Asia, though, but primarily Japan took the biggest hit. Europe woke up this morning with European markets down, although they closed off their lows. And initially, the U.S. market was down, but it came back pretty much. I think it recaptured all of the decline early on. And the headlines would tell you Carl Icahn, the hedge fund guy, leaving Apple, which had been a position of his for the last 2 or 3 years, did a number certainly on Apple stock and maybe on the market overall. I'm a little skeptical about the Apple story. Apple, we've seen days where Apple has gone up a bunch and down a bunch, and it didn't seem to impact the averages too much. It is no small position in the Dow. So perhaps it was more of an influence if nothing else really major was going on to offset it. I think really though, folks, it was more about what I've been showing you on the chart in front of you is that 1 year daily chart. I just think that the market rally that we've had, which has been a very nice rally, has been running out of steam of late, which my favorite technical indicator, or one of my favorites, has been telling us here for quite some time that we should expect some consolidation, like I said yesterday. Notice this line I drew right here at about 2075. The technicians were talking about that a lot today as support, and it held right at the end of the day. In fact, the S&P closed at 2075.81, so it closed just above that. So we'll see how we do tomorrow, but definitely this downtrend has been resistance. And, for these technicians that look at these patterns, upward wedge patterns are typically bearish. We could certainly break to the upside. But I've been telling you that my stuff, if you will, tells us to expect the market to consolidate, I think, in healthy fashion. So what happened today is just very consistent with what I think we should be expecting on a short-term basis. Now, when we dig a little deeper and get into the fundamentals, marvelous breadth in this rally, which we haven't seen for a while. When we have this kind of breadth, typically 6 months later, the market is higher. There are some headwinds. We're going to have the Fed to contend with all year. We've got Britain's referendum in late June, and then the U.S. election in November. So while we have good readings in terms of the market internals, I think, in a lot of respects, and I think the technicals look good as we ultimately get through some of this resistance. We've got valuations that are pretty rich. But if the economy, starts looking better, and I'm seeing signs that maybe the global economy will, and maybe even the U.S., when you look at some of the anecdotal manufacturing data, along with continued decent strength in services, relatively good strength, and I think good trending strength in housing, and a pretty strong labor market, you can make a pretty good case for 2016, notwithstanding a lot of the headwinds. So I think, folks, that's pretty much the long and the short of it. Let me just take a look at some of the other things that I was looking at earlier. I showed you the chart yesterday. The relative strength of developed non-U.S. and emerging markets begins to look up at this juncture. Let me just really quick make my last point. I want to basically repeat a point I made yesterday. And I think this is consistent with what we're seeing in some of the data. And that is the relative strength of the various sectors. The fact that financials are outperforming the market, and that's what that upward sloping line is showing us. The fact that staples are not, when they were so far this year, quite noticeably, at least right to that point. The fact that technology rolled over, now I think that speaks to IBM and some Microsoft and now Apple disappointing on their earnings. But I do think tech is still a legitimate, smart, longer-term place to be. Consumer discretionary hanging in there, but it's these last three. It's commodities, energy, materials, these kinds of stocks finally showing some relative strength and actually taking on some leadership is a nice indicator that maybe this economy is not ready to roll over, and certainly not the global economy. And I'm seeing it again in the surveys, particularly the manufacturing surveys. For the first time in a long time, the Institute for Supply Management manufacturing sector survey is above 50, which shows expansion. So again, while I am somewhat skeptical in the short term that this rally here has legs, longer term, I think we can be fairly constructive on the market with some headwinds and with some suspect valuations. But let's not try to time it. This is, again, me giving you some perspective that will maybe help you gauge your short-term expectations so you don't worry about market volatility if we happen to see more of it to the downside. This could be strong support, and we may just march right up to new all-time highs. There's indicators that tell me that maybe we'll see some weakness before we get to that point. Thank you, as always, for watching and listening. I'll be back very soon. Take care.